This is why I recently bought into Copart. So for reference, this is my entire portfolio. So I recently bought around 1% of my portfolio into Copart, and I'll be talking about another company, which is HCC as well. So let's talk about Copart first. Copart year to date is down around 18%. It is currently trading at a 30 times earnings. So why did I buy Copart? Copart is the largest car auctioning platform for salvage cars in the US. Copart has bought and accumulated junkyards over the years, and it is impossible for any competitor to start buying all these junkyards. So there are regulations in place now to prevent the sale of junkyards near your cities where the accidents mainly happen, and Copart already has existing land for all these different portions. And besides that, Copart's land has actually appreciated in value, so it's sort of like a tangible flaw for Copart investors as well. And lastly, Copart's CEO is actually a mentee of their founder, which is Willis Johnson. Copart's CEO, which is Jeff Liao, when he was around 16, 17 years old, he actually worked under Willis Johnson. So he worked as a cleaner, he worked as a car reseller at Copart as well. He worked many different jobs during that time, and currently he's the CEO of the company. So for Copart, this is their business model. What they do is they wait for accidents to happen. So whenever there's an accident that happens, your insurance companies, they will go and measure and check for the price of the car as compared to the repair cost. So if the price of the car is actually lower than the repair cost, what this means is that the car is deemed as a total loss, and then they'll pass it on to Copart, which will help to sell the cars to your rebuilders, to your dismantlers, to your international buyers as well, and your used car dealers. So for Copart, who exactly provides the cars for Copart? So it will be your insurance companies that provide Copart with the cars, and your insurance companies, they actually favor Copart over their competitor, which is IAA. So Copart and IAA, they each have around 40% of the entire market share. And for your insurance companies, they actually prefer Copart. And we've seen insurance companies, like for example Geico, favoring volumes towards Copart rather than towards IAA. So Copart's value proposition for all these insurance companies is to lower the cost on that side and to provide a seamless experience for them. Because your insurance companies, they typically have a lot more leverage as compared to Copart, because there's only 10 of them in the US. And for Copart, what they've actually introduced are two different features as well. So they introduced this thing called Pro Code, where it helps your insurance companies assess whether a car is labeled as a total loss. And they've also introduced this other thing, which is Title Express, to expedite the process of title transfers whenever a salvage car is determined as a total loss. So who buys the cars? It will be your rebuilders, your dismantlers, as well as your used car dealerships. So your rebuilders, resellers, as well as your international buyers, they typically buy the cars. International buyers, they buy the cars because they need to buy the US cars so that they can sell it for more profits in their own country. A lot of the US cars are actually exclusive to the US. So in order for them to get them over, they will have to buy it off of a platform like Copart. There are also about 100,000 repair shops in the US that buy salvage car by parts and then they use it to repair different cars. Why exactly doesn't the insurance companies just sell the car by parts instead of selling the car as a whole? So number one, it is time cost, and number two, it is human capital cost that will be involved as well. So that's why your insurance companies, what they like to do is to just pass the car on to Copart and let Copart deal with it. So for Copart's revenue stream, they mainly make money from two different segments. So your services segment as well as the car sales segment. The car sales segment is a very small portion of Copart's entire business. Whereas for the services segment, it makes up around 80% of the entire revenue stream. So for your services segment, they make money from both sides, your sellers as well as your buyers. So your sellers include your insurance companies. And for Copart, they charge a very small percentage of the car sale on the insurance side. They charge cleaning fee, transport fee, storage fee for the duration of the car that is in the junkyard as well for all these insurance companies. And on the buyer side, they charge handling fees, commissions, they charge membership fees, most of which are raised at prices above the rate of inflation as well. So for your buyer side, Copart has a lot more leverage, and that's why around 70% of the services revenue actually comes from the buyer side. And if you have to look at the membership portion is actually a recurring revenue for Copart. So every year, in order for the buyers to keep buying, they have to renew their membership. And Copart has actually increased the prices of the membership above the levels of inflation. And they currently have around 1 million members on their platform. So for Copart, what is unique about car auctions? So car auctions increase liquidity and increase convenience for your buyers. So it helps to increase the prices of the cars which is good for your insurance companies since they want to get the highest price for the car itself. And for your buyers, it lowers the time cost, it increases the convenience for them because they can simply buy a car off of the platform. So if you were to contrast this to in Germany, so in Germany there isn't much auctions for salvage cars. Typically what people will do is they will list their cars onto a platform and then people will offer, not in real time, for the car. And what happens when you have a system like this is people will lowball, and then what happens after that is the sellers will raise their prices so that people won't lowball. So it is a lose-lose situation for everyone in that space, and that is why your car auctioning platform is probably one of the better approach when it comes to selling a car. So for secular tailwinds, there are many different factors for Copart. So you have increased repair costs for the car as the car becomes more advanced. Your repair costs will be higher, which means there'll be a higher total loss frequency. There's increased complexity as well when it comes to the technology, which increases costs. You have higher urbanization, so as people move from countryside to cities, it will lead to more accidents. So greater miles driven will also be a tailwind for the company. So when people drive more, it leads to a higher frequency of accidents, which is overall good for Copart as well. As for the headwinds for the company, it will mainly be just these two things. So the first one, it will be your autonomous driving. So when your AV cars, they eventually come out, it will likely lead to less accidents, and less accidents means less volume for Copart. So that is one portion that will hurt the company. And the other risk is your uninsured drivers. So a lot of your drivers in the US, they can't afford insurance. And when you don't insure your car, what happens is Copart's volumes will decrease as well, which is a headwind for the company. But Copart's CEO has actually came out and clarified that your uninsured buyers, it is sort of like a cyclical cycle. So we're currently on an uptrend and you can expect a downtrend soon in terms of the trends for your uninsured drivers. So for Copart and the mode of the business, there will mainly be two modes when it comes to the company. The first one is the land mode. So Copart owns 20,000 acres of land. They own lands that are very close to your cities. They've built up this land over the past 20 years and they've been continually spending money on new land to try and increase the capacity that Copart can take in whenever there's a disaster that happens. So for Copart, they have actually bought this land over the past 20 years and a lot of the land value is not recorded as market value. So if you were to look at the book value for Copart, it is currently around $2 billion for all this land. But if you were to account for the ones that they bought previously in the past 20-30 years, then the market value for all this land is probably upwards of $4 billion. So it is hard for any competitor to come into the space because the startup cost is extremely costly. It will take $4 billion for a competitor to just come into the space without even having the auction liquidity to sell the cars yet. And besides that, Copart has a flywheel effect. It is similar to Amazon. So when more buyers come into the space, more sellers will try and sell their cars on Copart, which will lead to even more buyers as well, and so on. So it is sort of like a reinforcing loop similar to Amazon, which is what I like about the business, as it is a toll gate business that stands in the middle of your buyers as well as your sellers. So for Copart, this is my thesis for the company. So the company will remain a dominant powerhouse in the salvage car sector, and with your salvage car sector projected to grow at around 7 to 8%, Copart will likely grow a lot more than that. Copart's international portion are actually quite significant as well. So in the US, although they're not growing rapidly, their international portion is actually making up for it. So they have dominant share in UK, Brazil, as well as Germany. And in UK alone, they have around 50% of the entire market share there. So for Copart, the international portion is not as mature as the US portion, which is a future growth path that the company will embark on over the next few years. So for Copart, if you were to look at the metrics of the company's metrics are just elite. So this is their net income and then their revenue as well. It's just up and up and up all the way to the top right. So the only times where the company actually experienced a decrease in the net income was actually in this 2008 crisis. So in the 2008 crisis, when your economic activity was down, that led to a decrease in the car sales, which hurt Copart's revenue as well as their profits. But over the long term, this company exhibits one of the characteristics of a quality compounding machine, which is that it has very strong fundamentals for the company. So for Copart, this is my growth assumption for the company. So your expected growth rate is actually your ROIC times your reinvestment rate. So Copart's reinvestment rate right now is around 40%, and the ROIC is between 15 and 18%. So that means that they are expected to grow at around 7% based off of the reinvestments alone. So that is without the price increases, that is without operating leverage, and that is without inflation and buybacks for the company. So for Copart, the management is actually elite as well. So the management is fully aligned with its shareholders. So the CEO, for example, makes $1 for being the CEO of the company, with majority of his incentives coming in the form of stock-based compensation. So when your management is incentivized to do well, this will help shareholders as well. And Copart has been very opportunistic when it comes to the buybacks of the company. So if you have to look at the past 20 years, there were only a few times where Copart actually bought a lot of their own stock. And those times were actually the best time to buy into the company as well, when the company's fundamentals were solid, but the stock pulled back because of poor market sentiment. So for Copart, there is sort of like an artificial price law, because you can expect the management to buy back a lot of the shares if the shares become cheap enough, if the share meets their hurdle rate. So for Copart, this is the valuation. So the company is currently trading at a 30 times earnings, and historically this is around the mean value for Copart. So currently I think it's around fair value. For Copart, the current PE ratio is at around a 30 times, but they have around $4 billion in cash, and the market cap right now is around a 44 billion. And if you're to discount that, there is around 40 billion in terms of enterprise value, and they have $1.52 of EPS. So that makes the company's EV to E around a 26 times. So for a quality component like Copart, it is not super cheap right now at around a 26 times, but it is a worthy consideration, which is why I started a position in my portfolio today. I'm hoping for more downside with the company so that I can add more to this position. It will likely be around a 5% position in my entire portfolio. The next stock that I'll be covering as well is this company called Warrior Met Co. So Warrior Met Co year to date is up around 11%. It is currently trading at a 30 times earnings. So for Warrior Met Co, this company is the lowest cost producer of coal in the US. The company has recently opened a new mine called the Blue Creeks, and they will likely be able to increase their revenues by upwards of 70% when the mine is in full operation, because they will be significantly increasing the volume of their production. The coal prices are suppressed right now, and once we see a reversion to the mean, it will greatly benefit them. Why is HCC stock down over the past, I would say, 1 year? So number one, your coal prices have been depressed for years after the post-COVID boom. So it is normalizing right now, and because your Chinese are actually pumping a lot of steel, they're selling a lot of steel into the market because they have an oversupply, and that is hurting your coal prices. But for Warrior Met Co, there's nothing to worry when it comes to owning this company, because it is the lowest cost provider. When your coal prices are suppressed, what happens is a lot of its competitors will actually lose money, they'll run out of business. But for Warrior Met Co, because they're the lowest cost producer, they will still be able to survive in a depressed market, and while their competitors are being kicked out of the game, they will still be able to remain in the game. For HCC, if you're to look at the balance sheet as well, so if you're to compare its fundamentals to a lot of your different other commodities companies, this company has almost no debt. It is a debt to equity ratio of around 1 to 13 times, which is extremely healthy for a business like HCC. And for HCC, if you're to look at the dividend history as well, and if you're wondering how to get your money back, it is simply through dividends. So when your coal prices revert to the mean, what happens is HCC will give out dividends, special dividends to its shareholders. So at one point, it actually reached around 61% of the total stock price. So besides the capital gains that you can expect when the coal prices revert to the mean, it will also give out dividends, which is overall a plus with the company. Last portion, I'll be covering some questions left in the comments. So the first one, it says you have good stocks, but I don't think it is diverse enough. If we get into a tech bubble, you have limited downside protection given your holdings. Also, your cash position is too large. You are eroding wealth, not building it with this 31% cash position. So if the market goes up a lot, you will miss out on a lot of gains and lose your cash power due to currency dilution. So a few things to address here. Number one, my portfolio is not diversified enough. So I own a lot of different tech companies, yes. I would say in the tech industry, I consider ASML as a tech company. I would consider probably Meta as another tech company as well. Google is a staple. Microsoft is a staple as well. And I don't think my portfolio is overexposed to the tech risk if there ever is a tech bubble. So that's the first concern. The next comment, it says, United Health is a clear buy. It's a solid company with strong cash flow and the potential to grow revenue by around 6 to 10% annually over the next decade. Valuation is key here. United Health is trading at a discount, especially on a free cash flow basis, with a price to free cash flow of around 9 times. So I completely agree with this one. United Health is an extremely undervalued company today. And if you're to look at the free cash flow, if you're to do a DCF calculation, so these are my assumptions for the company, assuming a 0% free cash flow growth from year 1 to year 10, and assuming a 0% terminal growth rate for United Health, The company's intrinsic value today is at around $278 a share. So it is still 10% undervalued considering all these conservative estimates. So for me, I think United Health is probably one of the most undervalued stocks in the market. I've recently started this membership portion. Hopefully you can build a community here. I hope you guys have found this one useful and invest safe.